Welcome to Market Vision's Basics of Trading Options. Thanks for being here. This is a webinar in a different format of video. We've done a lot of video lessons, but this is more interactive than that. As I was mentioning, we're moving the session questions to the end of the session. We're doing the questions at the end, but if you have any questions, you can type them in the chat box. And I will answer them. I would request you to leave your questions to close towards the end because I might not see the chat box in the middle. So let's start right away. Can you all see the screen? The first PowerPoint screen that seems to have that has a Market Vision logo on the bottom right. Okay, great, fantastic. So this should work. This session will cover a lot of things, so I'm going to actually take it a little bit faster than I would have otherwise wanted to take it. There's a lot of content, but rest assured, based on the feedback of this, we'll do something else. We might do a follow-on session and so on. What we'll cover in this session is a brief introduction to options. I'm not going to go very detailed, but obviously because we have to get the fundamentals through. There's S. Kazi who says, I don't see the screen. I don't know what to do in this perspective. I haven't done anything specific for you, but I would request that you can re-log in. I think other people can see the screen. Okay, there you go. Okay, we're going to talk a little bit about options. We're going to talk about option pricing. This was there in the last Market Vision newsletter. I'm just going to refresh that. In an interactive format, one can get more information than writing. One gets bored of writing sometimes. I'll talk a little bit about Greeks, which I didn't do in the Market Vision newsletter. Sorry. And we will talk about trading options in India. Now, this is specific to India because we're talking about trading options. I will not talk so much about currency options today. In fact, I won't talk at all about currency options. I'm going to talk about stock and index options only. But the concepts continue to apply. There are many concepts in the US. People who are used to US markets will see different concepts, different things that apply to the US market which don't apply here. So I'm not going to discuss any of that stuff. As specific to India as we can get. We're talking a little bit about strategies. We're talking about how to cut risk, some covered calls, put rights, strangles and straddles. This is just a basic introduction to strategies. And of course, once you're in a position, how do you get out, or how do you move your position so that you can do a lot of stuff with options that reduce the risk of a position. Reduce the risk of a position after it has been taken. Lastly, pitfalls, things to watch out for. All right, what we won't cover in this session, and I would like to say that upfront, is I know that many of you come with more advanced knowledge of options, and you might end up being a little disappointed in terms of the basicness of the content. One thing we will definitely not cover is tips. I will not give any tips of what stocks or what options to buy or what not, because this is just an educative session. We're not looking at actual trades to be conducted. I will try to use examples that are more recent, but this is obviously not something that's investment advice. We're not going to talk about technical analysis either of the option data or of the underlying stock data or anything of that sort. We're not doing price analysis of any sort. We are also not going to do a lot of deeper strategies. We're not talking about, there are things like delta hedging, there are things like, trading the gammas and all that stuff, which is a very interesting topic in itself. It's great for big portfolios. It's great for people who want to work with hedge funds or mutual funds. Well, not mutual funds, but mostly hedge funds and FIIs and trading prop houses. But that's not something I'm going to cover here. I'm not going to cover a lot of stuff about option modeling, specifically things like fat tails and all that. I'll talk about it, in gloss over it. We're not going to do calendar spreads or some of the more complex spreads. I've just got about 3 or 4 strategies in there. There are about maybe 40, 50 different types of option strategies, and you can once you start reading about them, you find out the opportunities are endless. So I'm just going to kind of block it at 4. Right? Can you guys hear me now, or is the volume still low? I wonder why the volume's low. Okay, great. Thank you. I think it's different for different people. This is the unfortunate part of doing this on the internet. Okay. Thank you so much. I will not talk about ULIPs. I know I write a lot about this stuff, but I swear I won't talk about insurance policies and all that stuff. That's something we will not cover. We'll do a couple of prereqs. What you need to know is stocks. What are stocks, and if you've traded them in any form or format, you will be able to go through this session. Unfortunately, again, since I won't be covering a lot of the more advanced concepts. If you're already quite proficient in trading, and so I saw some of the comments, people are pretty proficient with trading, some of you. So to look upon this as a refresher course. It's more like something that's interactive, and I'm kind of cool. Just throw me any kind of questions towards the end, no problem. So we've got 41 attendees. I think it's ready to start the session. Let's just do a brief introduction to options to begin with. Now, if I were to tell you that you can pay me ₹10 and I will let you buy one share of Reliance at 900 rupees, but I'll only allow you to buy it at 900 rupees if Reliance goes above 900 rupees. Okay, so below that you don't have to buy it from me, and you can do this anytime by the end of the month. So you're like saying, okay, I pay 10 rupees, so if Reliance goes to 700 from here, I won't lose anything. Okay, and if Reliance goes to 1,000, I'll make 100 rupees as profit. Current Reliance price is, let's say, 880 rupees. And you're thinking, if it goes to 1,000 by the end of the month, I make 100 rupees, I pay this guy 10 rupees, and I make 90 rupees as profit. If it goes down, I lose only 10 bucks. It's like 90 rupees profit versus 10 rupees a loss. It's a great idea, isn't it? This is essentially what an option is. It's just to one party, to you, the buyer, it gives you the right to buy Reliance from me at 900 whenever you want, and you will only want to buy it if Reliance is above 900 rupees. Your break-even point at this point, your thinking is, listen, if it crosses 910 rupees, I am profitable. That's the idea. It's at 880 to go to 900 to 910 rupees is just 3% from here. 3% in the rest of the month is not a big move to expect. You will find stocks moving 2-3% a day nowadays. This is essentially what an option is. Now, if I were to classify two kinds of people, they're buyers and sellers. You're the buyer, I am the seller. You pay 10 rupees to me, that's a premium you pay, and you get the right to buy Reliance. If I am the seller, I get the 10 rupee from you, but I'm obliged to sell Reliance. If Reliance goes to 1,200 tomorrow, I have to sell it to you at 900 rupees. So that's, this is the right versus the obligation. Now this is just the way the contract is specified. In reality, what ends up happening is I don't own a Reliance share when I'm selling the option. You don't get a Reliance share when you're buying the option. That's the way the trade happens in India. What happens is we just settle on the price. So tomorrow, if Reliance goes to 1,000, you can say, listen, you promised to sell me a Reliance share at 900. It's gone to 1,000. You sell it in the market at 1,000 and give me the 100 rupees that I have earned. So I give you the 100 rupees that I have. You paid me 10 rupees earlier, so net you made 90 rupees. This is a cash settlement, so there's no share that is actually exchanged between the two. That's how the market works. I'm just clarifying it from a trading perspective, so you don't have to think about it as the right and the obligation as a complex mechanism here. Now, let's look at a very base level at what are the various terms that are involved. Reliance in this case is the underlying stock. The option is a contract that's traded between you and me. You paid me 10 rupees. Tomorrow, that same contract could be 11 rupees, it could be 15 rupees. There's a different price for an option. But the underlying is Reliance, which is the stock on which the option is based. The strike price in this case was 900 rupees. It could be anything. I could say I'll sell you Reliance at 1,000, or if it goes above 1,000. So strike prices can differ. The expiry date, I said end of this month, it could be end of next month, it could be 1 year down the line. Any of those terms, any of those, the expiry date is something that's part of an option specification in a way. Excuse me. So the premium is what you pay to be able to buy an option, and what you receive if you're selling the option. Now you can be both a buyer and a seller. Okay, this is very important to understand, because most option literature doesn't tell you who you're buying this option from. You can buy and you can sell. There's no problem either ways. There's something called exercise. So when I say I'll sell you Reliance at 900 rupees, when do I sell you that Reliance? I give you the option of buying Reliance at 900. Tomorrow if it goes to 950, can you buy it? The answer is yes, and there's an exercise concept. You basically tell me, I want to exercise my right today. So then I have to give you that right. Now the contract itself may specify that you can exercise it any day, or you can exercise it only at the end of the month. I'll come to that specific concept at a later point, but exercise simply, yeah, it's not very relevant today anymore for reasons I'll explain. The lot size, you can't buy one Reliance share in the options market in India, because SEBI specifies that these are derivatives. They need to trade in larger quantities. So the Reliance lot size is 250 shares of Reliance. So you can buy either 250 or 500 or 750, multiples of 250. So that's the lot size. One lot is 250. So one contract is about 250 shares. It's different. DLF is 1,000, Nifty is 50. A couple of other contracts, Bank Nifty is 25. So there's different lot sizes for different things. SEBI usually says 2 lakh rupees per contract. So approximately they take the price and say how many of these shares will add up to 2 lakhs. That's the lot size. They keep announcing. Sometimes they change lot sizes. Okay, that's not SEBI actually. The NSE does that. There are two kinds of options. Now I talked about where you can buy Reliance from me. What if you said, yeah, I own Reliance. I own a lot of Reliance shares and I want to sell it to you at 900 rupees. Right? So I can give you a right to sell also. That's just called a put option. A call option gives you the right to buy. A put gives you the right to sell. You're profitable in a call if the stock is greater than the strike price, and you're profitable in a put if the stock goes below the strike price. And when I say profitable, it means not including the premium. So we'll talk about that in the strategy area. Now, the graphics come through okay? I can see it okay at my end. I'm hoping that if there's a problem, just let me know. Okay, so we have different kinds of settlements. There are two kinds of, they're continental, terms here, American and European. American options can be exercised at the close of any day. Now, this used to be what stock options were earlier. European options can only be exercised on expiry. That means they have only 1 day in which you can tell me, give me my Reliance share. In the middle, now if I buy an option and you tell me only exercise at the end of the month, you're like, dude, what do I do in the middle? Reliance can go to 1,000 and come back to 900, right? In the middle, you can sell your option. If you've bought an option, you can sell your part of the contract to somebody else. Essentially, it's a contract between you and me. You're the buyer, I'm the seller. You can find another person who wants to be a buyer and you sell to that guy. He might say, I'll pay 50 rupees for this contract, which you paid 10 rupees for. So I got my 10 rupee premium. You sold it to somebody else for 50 rupees. You made the extra 40 rupees. Now for that person, the cost price is 50 rupees for that option. I'm assuming that, Reliance went to 900 and say 45 or something like that. And somebody else wanted to buy the option at 50 rupees. This is both American and European options can be sold to different parties. They can also, American options can be exercised at the close of any day. Now stock options were American, but as of Jan 2011, NSE converted all the stock options to European in India. For people who want the presentation, I'll put the presentation up later. You can download it and you can do what you want to do. So the European options that are now prevalent in India, there's something that's, I think the BSE has started, which will only be available. I mean, which are I think no sorry, they're not American. They're still American. I'm sorry. Everybody is every contract is European in India. BSE has introduced options recently. I just don't know the specific details because I don't trade on the BSE. The liquidity has been quite bad. Most of my information comes from the NSE. All options on the NSE now are European in nature. Commodity options, if they ever happen, are likely to be American in nature. They currently don't exist. Next, we have two types of delivery, and we talked about cash settlement. This is basically, I don't actually give you a share. I don't own a share. I just do sell you an option. You buy an option. I just give you the difference in cash between the strike price and the stock price on the day of expiry or on the day of exercise, depending on if it's American or European. Since it's India, I'll talk only about European options. So on the day of expiry, since all options will be exercised, if Reliance is at 1,000 rupees, I will give you 100 rupees. So I don't give you Reliance shares, we don't change anything, that's cash settlement. On the other hand, delivery is when you actually transact and transfer the underlying stock. Now BSE stock options are supposedly settled by delivery. That means if you buy a call, you will actually get the shares into your demat account. Now I don't know how this works for BSE. Again, I haven't traded it much, but I assume that there is some kind of way to handle different scenarios. Let's just stick to cash settlement. At least this is the most liquid option I know at this point. Okay, so the next slide, it might take some time to load at your end. We're going to talk a little bit about pricing. When we've why do stock options trade at a certain price? Why are you paying me 10 rupees for that 900 rupee strike price call option? There are two kinds of values for an option. There's a time and an intrinsic value. If Nifty is at 6,050, this is an old slide, it was created, in the good times. Nifty is at 6,050. The Nifty 6,000 call option may trade at rupees 75 in the market. So what does that mean? There's an intrinsic value of 50 rupees between the strike and the stock price. This is the price that's inbuilt in the option. That means if I took the option today and exercise it, I know I can't exercise it, but just to say that I could exercise it, I get 50 rupees. That's the minimum I will expect. But because I am a seller and I sell you this option for another, say, 15 days or 20 days or 30 days, I'll say, yeah, Nifty could go up from here. I am open to risk. So to cover that risk, I need some money. So I'm going to charge you 25 rupees extra for the next 15 days, for the next 15 or 20 days of risk. That extra is called the time value. So you've got intrinsic, you've got time, and obviously when you look at time value, it will deteriorate as you come closer and closer to expiry. Which means if you are maybe 20 days away, the time value might be significant in an option. Are you guys also having problem looking at this slide? Because I'm having a problem at this side. Okay, it's taking some time to load. So no? Oh, okay, great. Okay, so as you go closer, okay, I know the presentation, so I don't have a problem looking at it. So as you come closer and closer to expiry, you will notice that the time value portion of the same option, assume the Nifty is exactly the same value, the strike price is the same, the intrinsic value will remain the intrinsic value, it doesn't change. The time value will move lower and lower and lower as a proportion as you get closer and closer to expiry. On expiry, there is no time value because at that time you just exercise. So this is typically called the decay of the option. the option decays over time. Now the point is, now how do you calculate this option value? Intrinsic is obviously quite easy. This is the difference between the stock and the strike price. So the formula is like, just find what the difference is. If the stock is above the strike price, then your intrinsic is whatever is above. That's stock minus strike price. L0 is the reverse for the put. That means if the stock is below, there is an intrinsic value. If the stock is above, there is no intrinsic value. For time value, things start getting complicated. When you look at the time value, a lot of things will happen. Will you pay the same amount for a Reliance that moves maybe 1% a day, to compare to say Jubilant Foods that pays 15%, that moves say 5% or 10% a day? I don't think so. I mean, you'd say, listen, Jubilant Foods, if I were to pay for the option, I'll pay more because it's so volatile, it could go in my direction quite easily. Same way, if you are the seller of the option, you'll say, listen, there's too much of a risk. So the volatility of the stock itself will determine the amount of time value that you'll pay. Secondly, the amount of time remaining. Obviously, if tomorrow's expiry and the stock's at, Reliance is at 880 rupees today, the 900 or even say 1000 rupee call option, I think you'll get it for like 5 paisa, because nobody expects Reliance to move from 880 to 1000 in one day. Comparatively, if it was 30 days left to expiry, people would say, look, 30 days Reliance can easily go to 1000, so we'll charge more for that for that option. So time remaining becomes the other parameter. The risk-free interest rate, that is the amount that you have an opportunity cost. I can either buy this option, I can put this money in an FD for a month. If I buy this option, I'm going to stick with the option for a month, so it takes away from the interest I would have got in that case. So the risk-free interest rate becomes a parameter. If the risk-free interest rate increases, the amount of return you want from a particular option also increases. So if you are getting 9% in a 1 month FD, you might say 1 month FD 9%, I will want at least 10% to counter this. So the risk-free interest rate plays a reasonable part in calculating the time value. And finally, the nature of the contract. So you have American or European, you have call or put. You also have the distance of the stock and the strike price. We've talked about that in intrinsic, but that's also used in calculating the time value. So for instance, there's a different time value for an option trading at 1000 versus an option trading, option at a strike price of 1000 versus a strike price of 900 for Reliance, which is trading at 880. The distance between the two is also a factor in determining the time value. Whether it's a call or a puts, it has there's a slightly different way to look at things. So the way to calculate it will take this as an input, and there are multiple formulas for calculating option prices. Most popular is Black-Scholes. There's also something called binomial. You can see this graph. It may be a little light, but this is a distribution. So they assume stock prices are distributed along this kind of a graph. That means if the stock moves, the chances of it moving very, very far away are low, but the probability, as you can see over here, the probability of it being closest to where it is the highest according to the normal or binomial distribution. Well, I'm actually simplifying it. I'm not going to go into the math, but basically they assume that this is most highly probable and this is least highly probable. So in reality, what happens, and something that I mentioned I won't cover, is something called fat tails. There is actually a bump here in these two areas on each side. The point is that every once in a while there are these big moves that happen. A stock will move 15%. It's not moved 15% in the last 10 months, but one day it will move 15%, or 1 month it will move 25%. This is not supposed to happen if everything was distributed normally. It's like finding a person whose height is 10 feet. The chances are that person is probably one in a billion or something like that. And you know, if you find two people who are 10 feet tall, now you're thinking they're invaded by aliens because it doesn't meet any of the standard criteria. There are probably less than 5 or 6 people who are, you know, that tall in the, I don't know if there are any, but you know, just to, you wouldn't expect there to be more than a few, a very rare few that would exist, and that's because people's heights are normally distributed. But stock prices are not. Stock prices move in strange ways. So till a certain point, the probability is fine, and at some point, you know, probability shoots up towards the end. That's why the Black-Scholes model are very dangerous to use, because they don't believe that stock prices can move a large amount quite frequently, and unfortunately they do. But anyways, because it's the only model we have, and I'm not going to talk about fat tail modeling, we are going to use Black-Scholes largely as a concept to determine this. There are lots of online calculators that are written in the Market Vision newsletter, and I'll write in as a follow-up to this on the blog as well about online Black-Scholes and binomial calculators. You can input all these the inputs that are required, which are at this point there are about maybe 8 or 9 inputs that they take, but 5 are the most important ones. The most important ones are simply volatility. That means the percentage that you expect. I mean, this is the concept of volatility is that it's a square root of the sum of squares of volatility of something. So it's basically, you look at it as a percentage number. For a trader, it's more like, are you saying 25% volatility, or are you saying 40% volatility, or 50%? It's just a number. You're looking at inputs to these formulas, which are stock price, strike price, the time remaining to expiry. So you have to count holidays. So on Friday, you can't say, hey, next trading day is Monday, so you know, let's ditch the 2, and then there are only about 6 more days left to expiry. Not really, because if you put your money in a fixed deposit tonight, by Monday morning, you will get some interest. Well, most banks in India don't give interest, but assume liquid fund or a short-term debt fund or something like that. They will give you, you know, 3 days of interest. These formulas also take inputs like call and put, and they will throw out a price. So the idea will be that you input all these elements and the volatility and so on, and throw out a price. That price might differ from the screen price that you see. So you might see 75 bucks. When you run it through the calculator, you might see a price of, say, 85 bucks. And then you're thinking, you know, if my assumptions are right of volatility because much of this, there is no assumptions. The only assumption is volatility. So if you're assuming that the stock has a 30% volatility factor, then and the market's saying it's only 20%, you're thinking, no. You know what? Nifty moves on an average 30%. So I will take the risk. I'll buy this option. So it might seem to you to be cheaper or more expensive based on the kind of the volatility that is in the price. Let's just take a look at some of the things that people use quite often to measure options. So one we talked about is implied volatility. So there's something called delta. If a stock is at 100 rupees, you have an option that's at whose strike price is again at 100 rupees. If there is a change, you know, the price of the option may be, say, 5 rupees. If the stock moves 1 rupee up, how much does the option value move? So from 5 rupees, does it become 6 rupees? Does it become 5 rupees 50 paisa? Does it become 5 rupees 20 paisa? So for 1 rupee move in the underlying, how much does the option move? Typically, it's not supposed to move more than 1 rupee, right? Because you can't technically have that. But sometimes it does for strange reasons. In deep in the money options, when I say in the money, it just means when the stock is strike price is way below the current stock price. So if you're buying a Reliance is at 880, the 600 call option is very deep in the money. 600 call option will, if from 880 Reliance moves to 881, the price of the Reliance 600 call option, the strike price of 600, maybe 280.5, it will move to 281.5. So it moves 1 rupee, very or close to 1 rupee for every 1 rupee a move in the underlying. That's the delta. The delta is close to 1 for such deep in the money option. Deep out of the money or OTM option, or if there is an OTM option where the expiry is just tomorrow, chances of that, the delta of that might actually be 0. In the sense, a small change in Reliance from 880 to 881, the 1000 rupee call option may not change much at all. Because if I move 1 rupee now, it might not really impact my 1000 rupee option. On the other hand, if you're very close to the money, ATM is called at the money or close to the money puts or calls. For an 880 option, 900 may be close to the money. 880 strike itself may be 880 strike itself maybe is called at the money. OTM, just to refresh, is out of the money. I just call it OTM. It's just more of option parlance. ATM is at the money. ATM puts or calls will usually have a delta of 0.5. Now the idea of why this Greek was invented is because you have a portfolio, you may have a stock, you may have calls, you may have puts, you may have all sorts of things in your portfolio. But if you take the delta of all of these positions together, those deltas will add up to some number. And that will tell you that for a 1% move in the market, how much does my portfolio move? If I am a true hedge fund and I want to be neutral, that means for every long I need to have a short. That means if the market moves 5%, my long will go up 5%, my short may go down 5%, and I'm neutral. But technically I want to make some money, so I want the short to lose a little bit lesser, but forget that. I want to be neutral. I might say I want a delta neutral strategy. So with options, you don't know where your position will lie. If you have only stocks and you have equal number of shorts versus longs, then it's delta neutral by definition, because a stock is has a delta of 1. For 1 rupee move in the stock price moves 1 rupee. So a portfolio built of only stocks, you just have to compare the longs and shorts. A portfolio built of stocks and options together, you can take the delta, add them up. They will have a delta of, there will be +1 or -1. Plus 0.5, minus 0.5, things like that. They will add up and they'll come up with a certain delta. There are strategies called delta neutral strategies, which basically hedge the delta in the entire portfolio. We'll say, okay, net of all of my trades, I have a portfolio delta of 0.1. So I just have to buy an option which has, or sell an option which has a delta on the other side, minus 0.1. If I get a new position, then I'm in delta neutral. So that is one part of a delta neutral strategy. I won't go into details of how that is done and all that, but that's one of the useful reasons of Greeks. There are other Greeks, and I'm going to just quickly run through them. Excuse me, sorry. The other Greeks are something called gamma, which is the velocity of the delta. So the change in, as you get closer and closer to the money, you saw that if it's deep out of the money, it's tending to 0. If it's at the money, it's 0.5. So the delta changes on a daily basis. As the stock moves, the delta also changes. So the gamma just measures the change. So how much is my gamma? Simply, if there is a 1 rupee move in the stock, how much does my delta change? And that is the gamma. Now, okay, there's something called the Vega, which is, we talked about 25% volatility, we talked about 40% volatility. What happens with every 1% change in volatility? How much does the stock move, or the option price move actually? So if the stock remains at the same level and volatility changes, and when I say volatility, it may be people who expect, it's about expectancy, not about how much it actually has changed. So for instance, if Reliance announces today that, boss, I am going to buy a stake in Kingfisher Airlines, what happens to a Kingfisher Airlines stock? Suddenly people expect it to go up, or other people are saying, oh, Reliance is just bluffing, okay? So they expect it to go down, when Reliance might actually go and say, no, somebody misquoted us. So the expected volatility in Kingfisher Airlines stock goes up. So that if the volatility goes up, if I have a Kingfisher Airlines option, how much does that option price change when there is for each 1% change in the volatility? Right, so that's a Vega. I'm not again going to go into too much detail on this. There's something called theta, which is the time decay. Essentially, if the option remains, if the stock remains at this value, and everything else, option, implied volatility, everything else is the same. For every day that I go closer and closer to expiry, how much does the option for a buyer lose value? For a seller, it's a profit, because every day that the seller, the option is not exercised in a way, or is away from exercise, the time value comes lesser, it becomes profitable for the seller. This also, I talked about interest rates. So if interest rates change, how much does the option value change? This is a row which is, this is so theoretical, it is beyond me sometimes, but let me just leave that away. What is important is what's reality. I talked about all this stuff. Nobody does this in reality. Okay, in reality, you trade the price of the option. You just buy. Somebody tells you, I'll give you Reliance 900 call at 10 rupees. You have to now instantly say, boss, 10 rupees is good, 10 rupees not bad. They will not tell you, oh, I'm going to give you a row of 5, I'm going to give you a row of 0.1, I'm going to give you something, the Vega of 6, and you'll be looking at, what are you talking about? Nobody trades Greeks. Everybody talks about trading the price of the option. There are derivatives that called the VIX, which are traded in the US. Again, I said I'm not going to talk about the US, but you can trade the US VIX over there. There are futures called VIX, which is basically trading, which is in a way, well, forget that. It's trading the Vega and all that stuff. But you don't want to go there. You're when you're buying and selling options, you're trading the price. Now you will get it on some of your trading terminals as well. So when you double click an option, you might see row, Vega, theta, row less, but more like Vega, theta and all that calculated and shown to you. On the NSE website, you do have, let me quickly share a screen with you. I don't know if this will come on your screen, just tell me if it does. You can see the implied volatility of a particular stock. Now I don't know if this will work. Can you tell me, guys, if you're able to see my screen? Now I don't know if you are. Okay. Okay. Moving out. Disconnected. I don't know why I tried some starts. I'm back. Can you guys hear me? Yes. Oh, great. Thank you so much. I'm so sorry. I am going to paste that. Yeah, just go to nseindia.com. You can see something called an option chain. In the option chain link, you can actually see, if you click equity derivatives, there are for every underlying Nifty and all that stuff, they have a nice little thing. Let me just see if I can paste and upload. I think it's a little too late. I should have done this earlier. My mistake. You can actually see the implied volatility of each option. You can see the option chain. In the option chain, you'll see calls on the left hand side, puts on the right hand side, the strike price in the center. This is called a straddle view, and you can see on the left hand side, for the same strike price, you can see the prices of the calls. On the right hand side, you'll see the prices of the puts, and you will actually be able to see the implied volatility. It's one of the columns on the NSE website. Some stock, some client software like Odin or Now might actually provide it on an individual option in a different way. But you don't trade the Greeks. Remember that you trade the price. When you buy a price, nseindia.com. Oh, thank you. Yes, that's the link. And if that doesn't work, there's this one, which seems to be the same. Exactly. Okay, that's the link on the chat screen as well. When you buy options, you pay a certain premium. When you sell options, there is an interesting thing that happens. You get the premium, all right. Okay, you get the premium. It comes into your account, but it's an obligation that you have. You should, you don't have the right. The owner of the option, the buyer of the option has just paid the premium. He needs to pay nothing more. His risk is done. That's it. At this point, if the option price goes up, he can sell it or he can wait till expiry and then he will realize the profit. The seller, on the other hand, is like a person who's trading futures in a certain way. He's got an exposure. That exposure is unlimited because Reliance could go to 5,000, and that somebody has to say that, okay, boss, is this Deepak Shenoy willing to pay 5,000 rupees? He has to bear the difference between 900 and 5,000 because 900 is the strike price. The margin requires you to pay, the exchange requires you to pay a margin. This margin, there's an initial margin that needs to be paid at the time the contract is initiated. You will also pay additional margins as the price of the option changes. So let's say I sold a 900 call to you today. I might pay, of this I might pay say 200 rupees as margin to the exchange. I'm just giving you an example. It's actually 200 rupees into the lot size of 250. So I might pay something like 10,000, 12,000 rupees as a margin to the exchange. Now tomorrow, let's say Reliance goes up to 950. So 50 rupees is an intrinsic value built in. Now 50 rupees itself for me is a loss of 50 into 250. That's about, so 50 into 250 is about 12,000 rupees. This 12,000 rupees may be an additional margin that is requested of me by the exchange. So initially I'll pay 50,000 because 250 options, 200 rupees per option. So I'll pay 50,000 rupees, and then tomorrow when it goes to 950, they may ask 50 rupees more of me, so I will pay another 12,000, and so on. There is no mark to market as there is in most of the other most futures and all that stuff. In the sense, there's a subtle difference because everything is a margin. It's built into your margin itself. Now, for mark to market, you have to pay money. You have to pay Rokda, cash, whatever you think of. You actually have to pay to the exchange. Margin can be something else. I can give you a fixed deposit. A fixed deposit can be used as margin. I can give you a stock. A stock can be used as margin because the stock has value. So I might own a Reliance share. I'll say, yeah, I use this Reliance share as my margin. So you will actually, what will happen in, okay, there's a request to do an example. Let me just see if I have one. I don't think I have placed an actual option in here. Now, one of the issues is that I was hoping that I would be able to share my screen, but okay, let's just take a Reliance option, and I'm just going to quickly do this on the whiteboard. I hope you can see it. So let's say I have a Reliance, let's say I have a Reliance option, and I was able to write some text. How do I write some text on this thing? Okay, so let me just say that I wanted to Reliance at rupees 10, strike price of 9,900, lot size is 250. Okay, so what happens now is that my margin may be 200 per share. I'm a seller, right? So I am going to be selling this option. Okay, one of the questions is the margin different for different customers? No, in the sense for the most part, it is that the answer is no, in the sense that exchange determines, using some concept called span and exposure, how much margin needs to be paid by the exchange. If your broker says, yeah, I need more because you're one of those kind of guys who wants to run away, that's his prerogative. But literally every broker takes just what NSE charges. Everybody's a really everybody wants to conserve cash, nobody wants to pay more. So let's say the margin is 200 rupees per share. Now what will happen is you will pay an initial margin of rupees 250 into 200 is equal to 50,000. Okay, and then let's say Reliance goes to say 900 rupees. Sorry, goes to 950. Okay, Reliance was at 900. Our stock is at rupees 880. Now the exchange might say, I need an extra margin of rupees 70 per share, and that means you have to pay 250 into say 70, which is 17,500 rupees. Now it could happen the other way. It would go to 850. The margin reduction may be, instead of 200 rupees per share, they might say 180 rupees per share. So you would have paid 50,000. Now you pay an additional 17,500, 67,500. When let us say the contract expires, tomorrow at say 970. Okay, 960. Expires at 960. Now what happens is that your margin goes from you have to pay out 60 rupees has to be paid out, and that is equal to 250 into 60, which is 60, which is 15,000 rupees. Okay, the remaining is given back to you. So you paid out 50,000 initially, you paid out 17,500 subsequently, and then on the expiry day 15,000 is paid to the option buyer, whoever is on the option buying side, and the remaining is given to you, so that you will get back what, about 67,000, so about 52,500. Okay, so now one of the important things about here is oh yes, it's time for Q&A. I'm sorry, I got a little bit carried away, but we have another 10 minutes. I'll do one thing. I'll just do 10 minutes more of the session, and then we'll take it. We'll take Q&A from there. So we have some interesting pieces that have kind of delayed this. Okay, we've got liquidity. The liquidity in options is only in the index options for the most part. Bank Nifty, some of it mostly in the Nifty and the Mini Nifty. Stocks, there are lots of stocks that have liquid options, but there are very few in comparison with the 250 or even 1,000 stocks that are out there in the exchange. So probably about 10-20 stocks have real liquidity in options. That is a major concern. And even if they do have liquidity in terms of people are trading it, the bid-ask spreads may be wide. So a Nifty option that's deep out of the money, that's 3 months down the line, and so on, may not have much liquidity, in the sense where you might find a price of somebody will want to buy it at 45 rupees but sell it only at 90 rupees. So if you're buying, the cheapest price you can buy is 90 rupees, right? And there is no difference between Nifty and Mini Nifty other than the lot size. Some other differences which we'll talk about in another session. There's no concept of exercise anymore, since all stock options are European, other than BSE, which is an outlier. Okay, so we have brokerage. Brokerage per lot really sucks. The most brokers charge this. It's at 20, 30, 50 rupees per lot. If you look at the Nifty, if you have a Nifty 5500 call at rupees 10, lot size is 50. You pay 500 rupees. the price goes to 12. Okay, it's 20% increase in price. You will make 100 rupees. But if you pay 50 rupees per lot of brokerage on buying and 50 rupees per lot of brokerage on selling, you've lost all your profit just in the brokerage itself on a per lot basis. And this applies, this is on a per lot. So even if you had bought 1,000 lots, you would still not make any money. From 10 rupees to 12 rupees, you'll still not make any money because it's a per lot charge. So that really sucks. Now what we also have is brokers that offer you fixed price brokerage, which is either constant brokerage regardless of any number of lots, or a constant per month brokerage. That's what I use when I'm trading options. It's much easier. Other costs, you have securities transaction tax or 0.017% of the option value, which is really nothing. The option value is small. NSE and SEBI transaction charges, which are again small but could impact you, and STT actually impacts you. I'm going to put in another video. You can search for an STT and option prices video, which talks about how STT affects your option price itself. That is specific to India, but I'm not going to cover this in this session because it's a complicated concept by itself. There's also stamp duty that's different based on the state in which your broker resides. There are various kinds of strategies that you can use. There's a software called Options Oracle, which is reasonable for options. It's free. It downloads Indian stock prices, so that's pretty nice. I've used a lot of screenshots in this session from there coming forward. Brokers have their own software also, or a Sharekhan has something, and Edelweiss is something else, and all that stuff. We definitely need better options. Is a pain point in India. I admit and agree. So let me just talk about the strategies. Let's say you were long a call option. This is the way you might want to look at the option, because this is called a payoff diagram. On the x-axis is the strike price. This is the price of the stock and the strike price and all that stuff. On the y-axis is your profit and loss as determined by the option. By the way, I've stretched the class to 15 minutes more, so that we can take Q&A after in about 3-4 minutes from now. Sorry. You have a long call, which is essentially you buy a call. This is a Nifty call at 5100. A premium of say 60 rupees per Nifty. The max loss is 3000 for a lot size of 50. 60 into 50 is 3000. The max you can lose is 3000. Obviously, you can gain anything. The Nifty could go to 6000 and boom. That's where your stock price is. That's where your profit is. So the gain is endless. The loss is about 10,000. You can see here that as the stock loses value, your loss is exactly the same, and as the stock gains value, your profit keeps increasing. So that's your long call. It's basically speculation in the sense you're betting on the stock going up, and your break-even point is 5100 plus 60. 5160 is where you break even, and the maximum gain is unlimited. So this is your break-even point. Now the next thing that you can do is buy a put. Now let's say you wanted to do a downside protection. You own the stock, but you said, I don't want to lose money on the downside. I want to lose money. I want to make money, but I want to make money on the upside. Let's say you own the stock. You see this dark blue line, it's the stock. The stock's graph is 45 degrees, because if it goes down you lose money, if it goes up you make money. You buy a put, which is the pink line. The put's payoff is like this, in the sense below 200 you're buying a 200 DLF put at 3 rupees 25 paisa. Below 200 the put makes money. Above 200 it loses the premium of 3 rupees and 25 paisa, and DLF's lot size is 10,000 is 1,000, which is why you see these numbers slightly different. So this is actually 3,000. The distance between the pink line and the zero axis is 2,000. Sorry, 3,250. So the light blue line is the payoff of the strategy, which is owning the call and buying a put plus stock together, and together you can see that it loses some money on the downside, and at 200 it kind of doesn't lose any more below 200. But of course you pay this premium as well. So what happens is the stock, there's a difference between the stock and the strategy price, and this difference is the amount of premium that you paid. If that means if DLF stays at 200, you still lost the premium that you paid, 3,250. Okay. We also have different kinds of other strategies. I'm going to hang on, this is taking some time at this point. Okay, so you could short a call, and when you go short a call, as I said, you just have to pay margins. But you might want to say that, I've seen the stock, it's gone up a lot. I don't think it's going to go up a lot from here. So I'm just going to go short a call because I'll just take the premium. I don't think the stock's going to go beyond that. Then we will, one of the big problems is that, people might take this, and so what happens is the stock goes up, the strategy loses money. The stock goes down, it makes a fixed amount of profit. The break-even point is, again, this is a DLF put. So you buy a DLF call. So you sell a 200 call at 13 rupees. The stock's at 210. At 213, it starts making losses. One of the reasons why you want to go short options is because most of options that are statistically, most options that are written on the exchange tend to expire worthless. So if you write an option, you will most likely make a profit. Well, I'm saying that, but these are very shady statements to just make. I could also say that, listen, I like DLF, but I don't like the current price. I will buy it at 197. So what I'll do is I will sell a 200 put at 3 rupees. So if it goes below 3 rupees, it's equivalent to my purchasing the stock at 197. Because below that, I have the downside of the stock. Above that, I have some upside, the 3 rupee upside that I get from the margin. So if the stock goes up a little bit, then I still make 3 rupees. What happens is if it goes a lot up, say somewhere over here, it goes to 220 or 230, I don't participate in all that gain, I make only 3 rupees. Sorry. So it's equivalent to buying stock at strike minus premium received. Last two strategies, covered calls and straddle. So covered call is simply buy, like we did buy a put plus a stock. We have a stock plus selling a call. What you would do is you would have a stock of future in your portfolio. You would write a call option alongside. This is again a DLF 200 and writing a 200 call, 210 call, sorry, for 2 rupees 85 paisa. So your portfolio, which is the light blue line, would break even at 210 minus 285, which is about 207 rupees 15 paisa. Versus if you didn't do the covered call, you would start losing money right now, which is at 210 rupees. So the short call gives it a little bit of a buffer on the downside. What it also does is but cuts off returns on the upside. So you start noticing that at 240 or 250 your profit is constant. You don't make the same profit as the stock itself. Why would you bother with a covered call? Sometimes stocks reach a buying exhaustion limit. You might need to continue to hold stock, maybe for tax reasons, maybe because you just can't sell it. It's a family thing or whatever that you might want to say. That you say, okay, I want to just write calls to make some premium. I don't care about the upside anymore. You will eat some time premium if you think the stock has kind of exhausted its move. But it's not covered. It's not covered in any way for you. That means your downside is yours. Your upside is the one that's capped. So it's not really covered for you. It's mostly covered for your broker. That's all. Now you also have a straddle and strangle. I mentioned these in the Market Vision newsletter. This is buying a strangle. I like DLF. I'm going to buy a 210 call. I'm also going to buy a new 210 put. One at 675, one at 665. My break-even point is 210. This is not 201. This is 210. It's a spelling mistake. I'm sorry. Plus minus 13 rupees 40 paisa, which is the sum of the premium. So below 197 approximately, I make a profit, and above 223, I'll make a profit. Sorry, this is 223, and this is to 197. So A straddle is used typically, for an event-based thing, DLF's announcing results, or I know some news is going to happen, or I think that DLF will just move automatically because, people keep printing bad or good news about it. So I think it will move that much. So that's one piece of the pie. A straddle, another form of the same kind of strategy is a strangle, where instead of writing at the same strike price, I will do a put at 200 and a call at 220, and that would be my strangle. The risk is only 6 rupees. In that case, it was 13 rupees. So I would have lost 13 into 1000, 13,000 rupees for one strangle. Here I lose only 6,000 at the max. But my break-even points are 194 and 226. There it was 197 and 223. So slightly different break-even. So it's a slightly different risk pattern as well. In order to keep more time for questions, I am going to kind of cut this short at this point. I'm going to take the questions first, and then we'll come back to adjustments and so on. Okay? So why don't you let fly with the questions? I'll take them one by one. So Jay asks if we can buy call and put option with the same strike or the same expiry. That's a straddle. Is it a good strategy? Well, the idea is it depends on the price. So if somebody expects that this price has been very high, just before the elections in 2009, the prices were extremely high. People who are willing to pay, the Nifty was at 3,600 or whereabouts. Sorry. People who are willing to pay, I'm sorry, excuse me, one second, I need to just get a drink because throat is parched. Sorry. Yeah, here we are. If we can buy a put, if we bought a put and call at the same point, what would happen was the Nifty was at approximately 3,600. Let me just erase all of this and create a new whiteboard. Can I do that? Okay, maybe I can't. So, well, okay, here you go. Can you all see the new whiteboard? Okay, this is so you'd have a Nifty call and a put. This is, let's say this is just a call and a put. At that time the Nifty was trading around I think 3,600, and you could find the end points at around, the option premiums were so high, it was like 3,400 on one side and 3,800 on the other side. So you got, a huge 400 points for every straddle that if you wanted to buy it, you had to pay 400 rupees. Of course, after the elections, Nifty went to 4,200, so you made 600, so it was a huge gain. But for the option writer, this looked like a great opportunity. So now, just before budget, for instance, the prices are very high. It's all dependent on the price. I'm sorry, I missed a few other questions. Can we make money in options? Of course you can make money in options. You can make money in anything nowadays. But, I've just talked about it. Recently, I just made money off of a straddle. I tweeted it today morning. I talked about it in the Market Vision Chronicle itself. The prices seem to have come down recently. They expected just a 2% move in the Nifty in a month. So in the beginning of the month, I took on a Strangle, and today I covered it at about 40% of profit for me, which is not bad. I could have done better perhaps, but I'm happy. Typically, okay, what's the next question? Is there any software for implied volatility in live market? Most trading tools will do it. Odin now, NSE now. I think Sharekhan's Trade Tiger, that also does it automatically. It uses the price and calculates the implied volatility. After getting the implied volatility, how do you decide whether we can buy or not? Well, the answer is, it's not about whether the implied volatility is high or low. It's about comparing it, If it's 25% today and it's 45% tomorrow, you might think something big must have happened between today and tomorrow for that implied volatility jump to have happened on a particular option. Or if Reliance is at 45% implied volatility, but a similar stock, maybe an ICICI bank. I mean, banks are slightly different, but take a different large diversified player and say, would that stock implied volatility, should it be dramatically different? An L&T versus a BHEL, is there a difference? And that will tell you whether the stock price is which stock, which option to write or which option to buy. Typically, how long should one hold an option? Well, most of the liquidity is in the 1 month options. It's not in any of the months earlier. So, I don't think you have a choice today. But if you can, get a longer term option at a cheap price, I think, you should more than use it. Because you've got to have a theory of why you're buying the option or selling the option. Nearer to expiry, if I want to go long, no, well, the answer is, can I do a question is, can I do a straddle at 5,000 to go long on the market? The straddle doesn't really technically go long on the market. It has a downside even if the market goes up. So it's like neither long short. You lose money if you lose money if you're short a straddle. You make money if you're long a straddle only if the market moves a lot. Do we get interest on the margin from the broker? Depends on your broker. Most brokers in India I have seen don't give it. Of course, you could always give them a fixed deposit as a margin where you earn the profit. IV in a line or software, there is options Oracle, but I don't think there is an implied volatility. It's a good point actually. We need that kind of software in India. Okay. Any software to price mispricing in options? Now that is an interesting point. Again, there are lots of software in the US, but there's not much in terms of mispricing that's being spotted automatically. I remember we had written some few screens for it, and when I was with Money Yoga, but I don't think there's anything that's out there right now. What's the best strategies in the sideways market? You would want to write a strangle if it's sideways. So write an out of the money call, write an out of the money put, and eat that premium. The problem is in sideways markets, the premium also starts dwindling. So be careful. In the beginning of the sideways markets, write that thing. When the premiums reduce, get out. Don't do anything. Sometimes the best strategy is to not do anything. It's only when you got to trade when you can make a lot of money, not when you can make little bits, tiny bits of money. You shouldn't make $100. You should make $1,000, 5,000, 10,000 per contract. So that's the aim that you should have an option. You buy a call option now. Do you see the premium is higher? I'm sorry. I'm going to extend the session by another 10 minutes just to take through the questions. Can you hear me? Is the voice still there? Okay, it's just US Kazi. There you go. Okay, I got a lot of questions at one time. So I'm sorry, what was your question, sir, when selling the Sagar? Could you repeat your question, please? I'll take the other questions first. Sagar, can I make money in stocks? Of course you can make money in stocks, but I'm not going to talk about that right now. We're talking about options. I'm sorry, I would love to answer that question in a different way. So we've got, hang on, this chat software is not very convenient to see. So you can buy and sell put and call options. You can sell these contracts on the, hang on, I have lost this a little bit. Considering that, who sells fresh options? Well, let's say I don't own a contract. You don't own a contract. You want to buy, I want to sell. If a trade happens between both our bids and asks, then it's a fresh contract. If I already have something and I want to sell it, if I own a option and I want to sell it, somebody buys it, there's no fresh contract. Okay, so this is how futures or options work. We have, what a change in OI mean if it's a positive? If there's a change in the open interest, most likely it's the open interest. So each contract is a new contract, so the open interest might change. sometimes what happens, usually the most open interest is at where the options currently are. But sometimes when the stock moves very dramatically, there might be a lot of pent up old open interest at the old prices, the strike price. So if a stock price moves from 200 to 250 in one day, 25%, the 200 calls might still have a considerable amount of open interest. But usually what happens is all the open interest starts moving from the 200 to the 250. And it moves, if it doesn't move in one day, it moves in a couple of days. It moves closer and closer. So if an option suddenly sees a spike in open interest, it usually is a trading opportunity, and it tends to correspond with the price of the option as well. So the option goes up, the open interest goes up, and the underlying stock price also changes accordingly. The three of these parameters together can help you build a strategy to go long or short the option. Okay, I think I've answered the open interest questions. Rediff.com has a live FNO game. That's very nice. I didn't know that, and I would love to take a look. Is there a site that can, okay, would it be viable to use puts rather than short in futures? Yes, but puts have a premium, So what happens then is that puts, if you go short in futures, if the stock goes down 1 rupee also you make a profit. Versus even a put, if you pay a 5 rupee premium, the first 1 rupee may not make you a profit. The first 5 rupees won't make you a profit, might not make you a profit, I'm saying. And it depends on when it goes, so you got to time it right as well. So I don't have a whole lot of other questions. So I have more questions that I haven't answered. You pay premium on futures also, that's correct. How much should we expect per trade when selling options? It depends, again, on the options, the lot size. So here's the deal, what I'd say is for a 2 lakh, see, futures FNO lot size are very different. So today a DLF lot size is 1000, its price is about 200. Versus a Tata Motors, the lot size can be, I don't know, I think it's 500. The stock price is, or it's more now. So it could be dramatically different. So the exposure is much more. So the price that you would want to get is for every 2 lakhs, you want to make, this is the rule of thumb. Okay, if you're not getting 2% on it at the beginning of the month, then it's probably too cheap. That means you shouldn't be trading. You shouldn't be trading options and stuff that's not very volatile, unless you're selling them. And if you're selling them, you want to make sure that you adjust these options. I'll go through adjustment pieces. I'll put those up in the presentation as well. Futures premium less than, there's no premium, there's a margin you pay for futures. Futures you don't have the premium in futures is the difference between the stock price and the futures price. But the futures price can be less than the stock price as well, so the discount. There's no corresponding discount for options. I will never pay you to buy an option from me. You will only pay me. There is a premium, lowest premium can be 5 paisa. It cannot be less than that. Is the lot size same? Yes, the lot size is the same in futures and options. Exactly. Why is the put call ratio important? It's not important. I have tried testing a ton of strategies with put call ratios. I could not find a single one that works. Sometimes, you could get a random one that works, but I wouldn't put too much importance into it. It's a great statistic to have, just to look at it, but I don't see it tradable. The put call ratio, here's the PCR is not a contrarian, and since I've tested the put call ratio from 2005, it's usually a short-term signal. But I don't think it's a great contrarian indicator. A better way would be to take the puts and the calls and find out how much of that open interest has been changed over a small time period. This is much more narrow. You're right, we should actually go in. Munish, the open interest, you'll have to probably go through recording if you just joined. I did the open interest piece a little bit time back. Okay, last 2 questions and then I go back to adjustments, okay? SmartLink, this is not a stock thing, we're doing options, so we'll leave the options questions only. My most successful options buying strategy, well, I was short options through the 2008 fall, so, I was short I had bought puts. So that gave me a little, very ridiculous. I put 4,000 rupees, I made a couple of lakhs or something like that. So that was That was that. Books, websites, I will send this on the blog. I don't have anything to this thing. Why? Okay. I pause questions for now. I'll just finish this presentation. Okay. Adjustments we can roll up or down. So let's say, for instance, you have a 900 call. Stock goes to 910. You bought it when the stock was 810. Sorry, 850. When you've gone up, the time values increase because the stock's gone up, right? So you might say, let me sell the current option that I have and buy the 950 call. So the 900 call you might have bought at 10 rupees. 900 call went up to 50 rupees. You sold the 900 call at 50 rupees and use 10 rupees out of that 50 to buy a 950 call. So that is basically a roll up mechanism. A roll down you do for puts in the same way stock goes. I would not advise doing this when the stock goes against you. That means if you bought a call at 900, stock was at 880. Stock goes to 850. It doesn't mean you sell the 900 and buy the 860 call or something like that. It's not the right thing to do on the other direction, because what happens is you're losing premium. I mean, you're losing one trade and taking on another trade which has a higher premium. You should actually use a profit to get into a slightly lower ranging contract. So don't catch a falling knife. It's a very bad idea in options. In fact. Convert your position into a spread. Let's say you bought an option at 600, stock goes to from say 590 when you bought it to 700 rupees suddenly. Good news and all that. Now you go to the market, try to sell your option, nobody is there. There's nobody on the other side. Nobody wants to sell this option that you own. So you're seeing, or nobody else wants to buy the option that you own. So you can't sell it to somebody else. There's no liquidity. Now you want to say, listen, 700 is a damn good price. I want to lock my other stock could fall back to 600 tomorrow. What do? You buy a future. So if you're long a call, you you sell a future. You sell a future at 700 rupees, and at 700 rupees, from there on, you lock your profit at 700. It actually adjusts the position so that the profit is locked. Anything above 700, the short position will lose money, the call position will gain money, and it becomes fruitless. But on the downside, let's say it comes back to 600, your call option becomes 0, but the short option makes 100 rupees. Short future makes 100 rupees. The recording link will come in, and soon you can use. You can. I'm sorry. I talked about use futures. Convert position to a spread is, let's say I'm long a 600 call, the stock goes up, I'll go short the 650 call. So essentially when I pay 10 rupees premium for a 600 call, the stock goes up, the 650 call now has 10 rupees premium, so I will sell the 650 call, take another 10 rupees. That just becomes a second thing that I can do. That's for adjustments. Unfortunately I'm running out of time, so I can't do much. Pitfalls, don't overtrade. Options are very nice. So 3,000 rupees you can get exposure of 2 lakhs. It's great, but it doesn't mean that if you have 2 lakhs you should buy 50 options. Just because for 3,000 you can, it's huge leverage, but don't overtrade. Don't use that leverage behind you, because in options you can use 100% of your money. Stocks technically don't go to zero very often. Even if a stock goes bankrupt, somebody will be willing to pay 1 rupee for it. Options will go to zero very, very fast. They'll go to zero. There is an STT in India, and I'll send in the link on my blog. I think I should be able to get that link as well. So STT can dramatically, you end up with a huge problem when STT comes towards the end of an in the money option. That's one of the links. I think I've got a video on that. Yeah, the market vision video is also in there. You got time decay works against you. If you're long options, it works for you. That's something that you got to be careful about, because if you're long options, you like to only be long options, then time decay can kill you. Market-wide position limit. This is something that sometimes futures and options can have only this much available. let's say 10 contracts or 20 let's say there are say 100,000 contracts. The NSE decides the market-wide position limits for each stock. If the number of contracts reaches that limit, it will say no fresh contracts will be created on that stock. So the price can change dramatically. This is very specific to India. So when a stock starts reaching the MWPL, you can see the open interest daily. NSE also announces the number of stocks that are close to the MWPL on the terminals. So you would have to be careful, because at that time options can become illiquid. That means nobody is willing to come in, and you can't get into a contract unless somebody else who already has one end of the contract is wanting to get out and sell to you. There are crazy regulations in India sometimes. Recently, I think there was one of these stocks that just went through a major demerger and split. Suddenly, the SEBI decided that, or NSE decided, no more contracts would be traded from the 14th of November onwards. What do you do if you own a contract? This contract is supposed to expire in the end of November. They just cancelled the entire, they just forced the entire trade to expire on the 14th. New contracts were created starting the 17th for some reason, or sorry, the 4th and 7th, one of these two things was done. So if you own one of those contracts and you thought you could buy and you had a lot of time value and all that stuff, the time value goes to zero just like that. So that's one thing that you've got to be careful about. These are serious problems, and they happen in every market, but we have our share of crazy regulations as well. Dividend splits and bonuses can affect it. Options don't get a dividend. So if the stock announces a large dividend, just before the expiry date, that means the stock will go down by the dividend price on the day it becomes ex-dividend. So your option price will also go down correspondingly, because the option is supposed to expire only on expiry day. Everything's European now. So you find that dividends come in your way sometimes in your long options. It comes in your favor when you're short options. Splits and bonuses will usually not affect you, but what happens is, let's say a stock has a 10:1, 1:10 split, so one share becomes 10 shares. Your lot size was 250, now the lot size becomes 2,500 approximately, because of that. So things change dramatically in that context. So what they try to do is there are small things that you need to be careful about. I don't have too much time to explain about what happens when a split or a bonus happens. It's something that you got to be careful, because around the splits and bonuses, options tend to trade very violently as well. Okay, so we're nearly at the end. I'd like to thank you guys for this thing. I've done the questions pieces. Send me the questions at your lessons at Market Prison. We'll probably do future lessons for a fee at an affordable price. If people are kind of keen to do this, I will do more of these sessions. And I think I'll do another session just for questions on options. I think looking at the number of questions that are there, I haven't done justice in for 10 or 15 minutes. I'll send you the link to download the PPT. We will consider, okay, thanks again. A lot of the questions, send me the lessons at questions at lessons@marketvision.in. Thanks very much for, this is the one. Yeah, this is your email, and thanks a ton. I really appreciate your taking your time to come in and listen to the webinar.